Hello traders, welcome back to my channel. This is Junoy with Trading the Charts Pro, and here in this video I'm going to break down 5 elements that if you apply them to your swing trading, they can aid in increasing your probability for success while trading. So here we have a chart of slack work. This is a technological stock, but let's just jump into the charts and see how we can apply these principles and see how they would have assisted us to trade our swing trade. This chart, this is what I do typically in my trading, and it's something that you can implement to assist you to increase your profitability when it comes to you and you making your swing trades. All right, so number one, the first thing that I normally do is plan my trades. All right, how do you plan a trade? Well, in order to plan a trade, guys, the first thing you have to do is you have to pull up the chart and you have to find out what exactly is the price action doing. All right, that is the first thing that you have to identify in order to start planning out a trade. So right here, if you were watching this right around this time, how do you plan a trade here? Well, first thing, you've identified that this is a downtrend, and you can see it hit support, come back up to resistance, come back down to support, back to resistance. So now you would actually be planning or looking to take a short on this because it's in a very clear, nice downtrend. So how do you plan? Well, you have already identified the resistance and the support. All right, so now you know that, hey, if we're gonna short, we're looking to short this somewhere close to the resistance, and when it gets down to the downtrending support level that we have projected down into the future, we would be looking to close out that trade whenever it hits down to that level. All right, so that's number one. If we come over here on a horizontal basis and we apply the same planning the trade principle, it would mean that we have identified the support, we have identified the resistance. We see clearly, let me change the color. We see clearly that price came down, held the support, run up, resistance, came back, held the support. So how do you plan a trade? Well, this is the low risk entry. You take a trade. When it gets back to your resistance, now you look to close that trade out. That is planning. Planning really means that you're identifying what is really going on in the price chart, and you're going to position yourself to take advantage of what is basically happening in the price chart. All right, so number one, you have to plan your trades. That's the first thing in order to take a successful swing trade. You cannot just jump into the market and just jump into any stock and think that you're gonna make money. Yes, a lot of people think that's how it works, but that's not how it really works in real life. All right, so number one, plan your trades. Number two, this one is very, very important, guys. Time projection. What is time projection as it relates to swing trading? Well, this simply is you're just looking at a pattern that you have seen in a price chart in the past, right? So for example, we saw that price held support, it ran up to resistance. When it comes back to the support and confirm that it is holding support, now when you take this trade right here, you have to make a projection into the future of how long do you think that you're gonna have to stay or wait in this trade for it to hit your target, which it did hit back in the past. Okay, so as it relates to projection, you have to be able to project how long, where do you see price action going, and how do you wait to see where it goes. So basically, if we were projecting, we can see that 1, 2, 3 days. It actually took 3 days from the support to the resistance. So when we get back around here, we're gonna plan it out. So we're anticipating that it's gonna take a minimum of 3 days to get back to the resistance, and it took 1, 2, 3, 4, 5 days. So actually this time it took 2 extra days for the price to get back to the resistance level. This is very, very important, because when it comes to selecting an option and choosing the right time or the right amount of time for your option, this is a very, very critical part of selecting your option. So typically with an option, you know that it took 3 days right here to get back to resistance. That does not mean that you're going to come over on this side and buy a 3-day option. Typically, to be safe, you normally want to give yourself 2 to 3 times the amount of time that it previously took to do what it did on your option. So it took 3 days there. It doesn't mean you're going to buy a 3-day option. You could look to buy a 30-day option, you know what I mean, or a 14 days option, because you know last time it only took 3 days to hit the resistance. All right, so that's number 2. Number 3, this one, as it relates to right here, this is a very small zone, but it's still okay. Scale in and out of your position. In a tight zone like this, it's a little bit harder to scale in and out of the position because the target is so close, but it doesn't matter. What's important is you saw it hit support. It was down here 1, 2, 3 days. So you could have took a position on day 2, and you would actually buy you know, around 50% of what you actually wanted to hold. So if you wanted to carry 1,000 shares, well, when it hit support right around there, you would have just bought 500 shares, right? And then when you see day 3, day 4, it straight start to work in your direction. Now you go back in and you pick up your additional 500 shares. So now you're all in for 1,000 shares, which you wanted to have overall. That is scaling in. Now day 4 or 5 comes around. Now you start to scale back out of the position by putting some profit in the bank, so that, you know, if this thing just drop, you already start to minimize your risk, because it's approaching the target that you have predetermined by actually planning the trade. Okay, so that is how the scaling in and scaling out method works as it relates to your swing trading and increasing your percentage of profitability, or just increasing the probability overall. Because yes, we could have got in down here and the trade completely goes against us. If that was the case, the scaling in method would have worked perfect, because it means that you did not go all in on the position with 1,000 shares, and then this thing completely went against you, and now the loss is way bigger. Does that make sense? So that is how we would apply the scaling in and out method. All right, number 4, guys, this is very, very important. Giving yourself enough time. I know right down here, all right, for example, price run up, hit the resistance. Let me clean this up. Price came up, hit the resistance, it came back down. It didn't come all the way, so maybe we just wait that one out. Price came back up, consolidated a little bit, but then it came back to support. Now at this level, it's very important. Now we want to take the very same trade, but we're going to give ourselves a lot more time, because as long as the trade is going in the right direction, there is nothing to do. Just give yourself time, because you have already identified, 1, the risk level, number 2, where is support. So given that the trade is actually moving in the right direction, just give it time and let it do its thing. All right, number 5, we have to determine our stop loss level from day 1. All right, so what is the stop loss? The stop loss is actually the place that you no longer want to own this trade. All right, and that would be the support. So we're actually saying that we're gonna put the stop loss just a little bit below the support, because if it breaks this level, then, you know, we no longer want to own that trade. And this would basically tie back into planning the trade. So you would have ultimately identified your stop loss level before you enter the trade. All right, your stop loss level is very important, because when we look at the chart over here, if we had, you know, took this very same trade, put a stop loss here, the trade did not immediately work out because price broke down and it went lower. So that basically says that at this level we no longer wanted to own it and would have been stopped out, hence lowering the risk, given that the trade is going against us overall. All right, guys, so that's my 5 pointers that can assist you in making more productive, more profitable swing trades. If you like them, you know, please give me a thumbs up, subscribe to the channel, and share this information with someone that you may know that could use this information. Also, if you have anything that you'd like to add, you know, that we can add to, you know, our checklist as to enhancing our swing trades, go ahead and leave them down there in the comment section, and I'll definitely, you know, reach down there and talk to you, and we can talk about it. All right, so until then, I look forward to seeing you in my next video.